In this video, I want to talk about market cycles. And the reason I want to talk about market cycles is because I keep seeing people making the opposite choices to what they should be making based on where we are in the market cycle. And the reason this is bad is because it can financially ruin you or your business by making these decisions at the wrong time. Wouldn't you like to know when the best time to buy a house is? I'm pretty sure you'd prefer to make money on your house rather than be in negative equity or because you bought it at the wrong time. So we're going to look at three examples, three different market cycles, which, while they're all independent of each other, they're all also connected as well. Sometimes one can crash, but it won't affect the others. But most of the time, if one has a big crash, this affects the others as well. So by understanding where we are in each market cycle, you can choose the best strategies. And we'll talk about what these strategies might be and when the best time to use them would be. So what is a market cycle? The definition of a market cycle by Investopedia is a term referring to trends and patterns that happen in a market over a long period of time. So to make that even simpler, a market is where you have buyers and sellers, and a cycle is a period between when those products that are on sale are at their cheapest versus when they're at their most expensive. So that is a market cycle. And what dictates that is how many buyers there are versus how many sellers there are. This is just the basics of supply and demand. If there's more buyers than sellers, then it means that the value of what they're buying increases. Let's look at an example in real life. So let's imagine there's one house for sale and there's 10 buyers that want to buy a house just like that one. Each of those buyers bid for that house, pushing the value up until only one buyer is prepared to pay that highest price. So increased demand from people that want to buy a product means the price increases. On the opposite side to that, if there's 10 houses for sale, but only one person that wants to buy, it means 9 of those houses aren't worth anything because there are no buyers for them. So all 10 homeowners try to list their house for sale at a lower price than the other 9 so that they can get that buyer. Rather than bidding the price up, the price is being bid down. So that's supply and demand. But let's look at the property market cycle so you can see why we go through this cycle. This chart shows the average house price in the UK since 1975, and it's been adjusted for inflation. I've got another chart that shows the actual price, which shows it currently about 20% higher than that previous high in 2007. And you can see how every decade it goes through this recurring pattern of increasing in value and then crashing. And most of the time, in every crash, the average value of the property drops between 40 to 60%. Now, one of the arguments that some people use when they talk about property always going up in value is they'll say there's more demand for housing now than ever before. There's a housing shortage, that's true. And you think that would represent a factor on that demand side of the equation that we looked at a few minutes ago. But that's where people are getting it wrong. The demand for property isn't dictated by how many people need a house. It's dictated by two things. The first is the affordability of that property, and second, the availability of finance. If you remove either of these two factors, the property market will crash. When a recession happens, what's basically happening is there is less money circulating in the economy. Some people might say that recessions are caused by central banks removing money from the economy, which means people are spending less, they can't borrow as much, and because people have less money in their pocket, it means the value of goods and services reduce in value, down to whatever people can afford to pay when they don't have access to that credit. So as we're looking at the property market, how can you tell when the market is reaching its peak? And there's a couple of ways you can gauge where we are in the market cycle. And this isn't exact, but if you start to notice these little signs, you can start to see when we're reaching the top of the cycle. So as an example, When we're at the bottom of the cycle, in other words, after a crash in the market, the banks will normally have lots of lending criteria, like you'll need to have at least a 30% deposit. The amount they'll lend might be as low as 2 or 3 times your annual income. But as it's reaching the top of the market, banks will be offering 95% or 100% mortgages. And you might see them offering 5 or even 6 times your annual income. Some other things that are a bit of a giveaway is that they offer incentives. One bank I saw, they were offering 110% mortgages, and they were even giving people cash back as well. Others, you might see developers offering incentives to get you to buy. They might offer to pay your stamp duty or legal fees. And this is the real telltale sign, because it means that buyers have slowed down and they're doing whatever they can to pull in those last few buyers. So that's the property market. So let's look at the stock market. So this is a chart of the S&P 500, which is one of the main stock market indexes for America. And you can see that, as with the property market, this also goes through these cycles every few years. And normally this is every 7 or 8 years. Now, if you were interested in investing in the stock market, don't you think it would be a good idea to know when the best and the worst time is for you to invest your money? Imagine how devastated you'd be if you invested your life savings and then the markets collapse the next day and you end up losing 80% of your life savings, all because you didn't understand these market cycles. So let's look at when you should buy and when you should sell. So this is the lazy person's guide. The first thing I'll say is this is not financial advice. And before you make any investment into anything, you should do your own research and due diligence into that investment as the best time to buy or sell, or whether you should buy it at all. But Warren Buffett, who has much more experience than me of the stock market, he gave a very simple example of when to buy and sell anything, whether it's shares in a public company, a house, a business, or anything. So he said, if you imagine the sine wave of the market cycle, you've got the bottom of the cycle, which is when it's at its cheapest, and you've got the top of the cycle when it's at its most expensive. Now, if you draw a line at the midpoint of that cycle, that's basically represents what that product is actually worth. Every time the value of that product is above the line, you should think about selling. Every time it's below the line, you should buy it, because you're basically buying it at a discount to its true value. So the chances are, if you're watching this, you're either interested in buying a property, or you might want to invest in the stock market, or maybe you own a business. So we've covered the first two. So let's talk about the last one for business owners. Now, the market cycle you as a business owner should be most interested in is the cycle of the economy, because that dictates how much money is flowing in the economy and how much money customers have to be able to spend with your business. So most Western countries go through a recession about once every decade. The last real recession was a crash in 2008, 2009. Now, the definition of a recession, for anyone that doesn't know, is it's 2 consecutive quarters of declining growth in the economy. So in other words, the total spending in the economy keeps reducing for 6 months or more. So if you're a business owner and you go into a recession, the normal way that people act is they focus on survival. But there's a few things you could do differently rather than just battening down the hatches and hoping for the best. Some of the biggest and most successful companies around have grown the most during times of recession. So let's look at each stage in the market cycle to decide what the best strategy is at each point. So if you wanted to sell your business, 2019 was probably the best point for you to do that. At that point, you can see we were just reaching the peak of the cycle. If you were on the other side of that and you were the buyer, then there's lots of money available in the market. So you can borrow money easily to go out and buy that business. Now, obviously, remember you're reaching the peak of the market, the peak of the cycle. So you have to make sure you can afford to pay those debt repayments even when the market turns. During that upward stage in the cycle, you should either be selling the business or having massive growth, because it's at this time that your competitors are growing. So you need to grow, or else you end up losing staff and customers to these other firms. In theory, you should be able to increase your prices during this upward stage as well, because the higher you get in the cycle, the more scarce resources become. And you'll have probably experienced staff shortages during the last upward stage in the cycle as well. So that supply and demand equation we looked at earlier, the demand is much higher than the supply side, so prices naturally increase. But on top of all this, you should also start to build up cash reserves, especially as you reach the top of that cycle. Now in 2020, this was the peak of the cycle. Then the next 2 years were just starting that decline. They were a bit like being at that tipping point. So the strategy at this point is to reduce all of your overheads and costs and hold on to as much cash as possible. You need to try and convert your fixed costs into variable costs. There's two reasons for holding cash. The first is because you might need it in the slower periods that are coming. And second, because there's going to be a chance to buy things at a discount. Now we need to talk about when we're at the bottom of the cycle, which is in the middle of the recession. The strategy here, most of your competitors will be focused just on survival. They'll get rid of key staff, and their business might be on real life support. The first thing to focus on is that you have a strong foundation, and that means having cash to support the business. Clients will probably pay late, and there'll be some that don't pay at all as they go out of business. Then when you've got your own foundation in place, the best strategy is to go and invest in growth opportunities. That means creating new product offerings, creating new business models, buying other businesses that might be struggling, and generally investing in these discounted opportunities. Then you want to identify and attract the key staff from those other businesses. You want those key people that manage client relationships. You want those people that are best at the delivery side. And you want those that are good at the management of the business as well. It's at these times that there's high unemployment. So if you can create opportunities, this is your chance to find the best staff and really transform your business, ready for when you come out of the other side. It's this point in the cycle you should be seeking investment, so you're ready to accelerate the business as we start to come out of the recession. And finally, it's at these times when clients are probably suffering from poor service levels because the regular suppliers are being too cautious, and so they can't meet the demand like they could before. So this is an opportunity to get in front of these companies that might be your target clients. The final thing I want to talk about for business owners, if you want to sell your business, the better option might actually be to attract investment during that downturn period. Then you can really grow and accelerate it and take advantage of that next upward turn in the cycle, and then sell it as we start and reach the peak of the next cycle. So that's it for this video. If you've not seen my other video on how to increase the value of your business, where I go into a lot more detail about how small businesses are valued and what you can do to increase its value. So if you've not seen that video, then go and watch that next.